Central banks. You hear about them all the time. They're these incredibly powerful financial institutions. And when they make a move, the whole world seems to watch. But for most of us, what they actually do can feel a little, well, mysterious. So today, we're going to pull back that curtain and get some clear answers. Right, so there's this popular image of a central banker, maybe sitting in a big office, pulling strings like a puppeteer who controls the entire economy. But is that really accurate? Do they actually have that much power? Let's take a closer look and figure out how much of that is fact and how much is fiction. Okay, here's our game plan. First, we'll talk about their role as the financial backbone of an economy. Then we'll break down their three main jobs. After that, we'll look at their number one tool, interest rates. Then we'll get into some common myths versus the reality. And finally, we'll wrap it all up with the key takeaways. So, first things first, what exactly is a central bank? I mean, why does almost every country have one? Let's build a really solid foundation here. Think of a central bank not as the bank on your corner, but more like a foundational pillar that holds up the entire financial system. Its purpose isn't to make money for shareholders. It's all about providing stability and making sure people trust the country's currency. So here's the formal definition, but let's break it down. A central bank is a public institution. That's key. Its main job is to manage the country's money supply. That's all the money in circulation, from cash to digital balances. And the big goal is usually to keep prices stable. It's not in the business of making a profit. And this is a really important difference to get. Your local commercial bank, it's there to serve you, me, and local businesses. The central bank, on the other hand, serves those very banks and the government itself. That's why people often call it the bank for banks. It sets the rules of the road that all the other banks have to follow, all for the sake of economic stability, not for profit. Okay, so if their main role is to be this financial backbone, what are their actual day-to-day jobs? Well, it usually comes down to three core responsibilities. First up, and this is the one you probably hear about most, is maintaining monetary stability. Basically, that means trying to keep inflation, the speed at which prices are going up, low and predictable. Second, they work to ensure financial stability. They're like the referee, supervising the commercial banks to make sure they're playing it safe. And third, they act as the lender of last resort. If a healthy bank suddenly has a short-term cash problem, the central bank can step in with a loan to prevent a wider panic. All right, so we know what they're supposed to be doing, but the million-dollar question is how? How does one institution actually influence an entire economy? Well, their main lever is something called monetary policy. Monetary policy is basically the toolkit that central banks use. By adjusting interest rates, which is really just the cost of borrowing money, and influencing how much money is flowing around, they try to nudge the economy in the direction they want it to go. And they really have two main moves. Think of it like a faucet for the economy's money supply. If the economy seems slow, they use an expansionary policy. They open the faucet by lowering interest rates, which makes borrowing cheaper and encourages people to spend. But if the economy is running too hot and inflation is getting high, they use a contractionary policy. They tighten the faucet by raising rates, making borrowing more expensive to cool things down. So how does this actually trickle down to you? Well, it starts when the central bank changes its main interest rate. That immediately changes how much it costs for commercial banks to borrow money. Then, those banks pass that change on to us through the interest rates on things like mortgages, car loans, and credit cards. All of a sudden, the cost of buying a house or car changes, and that directly influences our decisions to spend or save. Now, as you can imagine, this incredible power to influence the cost of money has led to some pretty big assumptions and some major misconceptions about what central banks can actually do. So let's try to separate the myths from the reality. This quote really captures the common perception. And look, there's no doubt that central banks are a dominating force. But being a dominating force is not the same thing as having total control, and that difference is absolutely crucial. Okay, so one of the biggest myths is that central banks are like a shield that can stop any financial crisis from happening. The reality is, they're more like financial firefighters. They come in to manage a crisis once it's already started. In fact, some people argue that by keeping interest rates too low for too long, their policies can sometimes encourage the risky behavior that leads to a crisis in the first place. And if you need some proof, look at this number. One major study found there were 147 different banking crises around the world just between 1970 and 2011. And this was an era when central banks were very influential. So clearly, they can't crisis-proof an economy. The other huge myth is this idea of absolute control, that they can fine-tune the economy like a thermostat. The truth is, they just can't. There are way too many other things going on. Government policies, global events, new technology, even just how people are feeling. And as for controlling prices, well, since the US Central Bank was founded back in 1913, prices have gone up more than 23 times over. That's hardly a record of perfect control. Okay, so now that we've separated what central banks are from what they are not, let's just lock in the most important things to remember. If you only remember 4 things, let it be these. 1. They're a bank for other banks, not for you and me. 2. Their mission is stability, stable prices, and a stable banking system. 3. They work through influence, not absolute control, mostly by changing interest rates. And 4. They're incredibly powerful, yes, but they are also fundamentally limited. They manage crises, they don't perform miracles. Understanding their true role, powerful yet limited, influential but not all-knowing, is really the key to making sense of so much economic news. And it leaves us with a final, really important question. In a world that's changing so fast, with things like digital currencies and new global challenges, how is this essential role going to have to evolve?